What's going on, guys? We're going to be going over an option strategy to make hundreds of dollars in just a few days. So we're going to be using a firm stock here, and as we can see, it's been taking quite a dip at negative 15% on the day. So what better time is it than dips like these to sell cash care puts on? And especially since this stock is very cheaply priced at only $26 per share, we can sell multiple contracts and collect even more income by receiving lots and lots of premium, especially since implied volatility is very high. We can assume that the premium we're going to be collecting is going to be high as well because people right now are bearish on it, which means that the premiums are going to be a little bit inflated, which we can use to our benefit. So what exactly is Affirm? They're actually a partner of Microsoft, so it's a pretty decent company, but they operate a platform for digital and mobile first commerce. Its platform consists of three core elements: a pointless sale payment solution for consumers, merchant commerce solutions, and a consumer focused app. So this stock is down quite a bit from its all-time highs of around $164. So it's going to be a really good dip buying opportunity. And we're right now we're breaking new all-time lows because the stock has never been this low before. It IPO'd at $49 per share, skyrocketed, and it's been really shaky. But if we take a look at the technical analysis, we can see that the RSI is indicating an oversold territory. So we're really expecting a rebound. Of course, the stock isn't going to go down forever. So we're going to be capitalizing on the high premium and implied volatility by selling some cash share puts. And we can make some decent money just by selling this March 18th expiration date. If we head over to the options chain and head over to the March 18th expiration date, which is 3 days from now, we can see that the premium on these contracts are going to be very, very high. So the one I'm eyeballing is going to be this $21 strike is going to be pretty good, but you could honestly do anywhere between the $24 strike or even the 22.5 strike. Not sure why these other contracts aren't loading, but those would be pretty good as well. For this example, we're going to be using the $24 strike, and we're going to be receiving $111 of premium for opening this contract. And if you see this profit and loss expectation chart, we can see that as long as the stock price remains above $22.89, we're going to be making some profit. If the stock stays above $24, then we're making a full profit of $111. And keep in mind, when you sell options, all that credit goes directly to your buying power, and you can do whatever you want with it. You can buy more stocks, you could withdraw it, pay off bills, anything you want. That's your money to keep. But let's go ahead and see how much profit potential we can make. So let's assume our account size is around 25,000, which is a good size if you want to get into selling options, because selling options does require a good amount of capital because you have to have enough collateral to cover 100 shares. So let's go ahead and assume we have 10 contracts. So we have $25,000 collateral and we want to sell 10 contracts. We're going to be receiving 1,100 credit for 1 week, because remember, we're choosing the shortest expiration date. This isn't even a month out where we could receive even more money. But if we keep doing this week over week, we can make $1,100 every single week. And if we go over to the option profit calculator right here and we enter in our strike price of $24 here, we can see really good profit potential. If the stock remains flat, you're making money because of time decay. Remember, as option sellers, as time decay is on our side, so that's our advantage as an option seller. And our chance of profit is going to be a lot higher than an option buyer, but 71%. That's why I like selling options. It's a win-win situation because if the stock drops below $24, you are going to be losing some money on stock devaluation, but you own 100 shares of the stock. So the downside is you own 100 shares of the stock, which isn't that bad. So you're winning either on the premium side or the stock side. Of course, we want the contracts to expire worthless. That would be the optimal strategy. But worst case scenario, you're owning 100 shares. So that's about it for this video. Thanks for watching.